prices for total service input moved down 0.3%, and lower prices for iron ore, steel, scrap, wireless communication services, natural gas, diesel oil, of all things, outweighed advances in the index for metals and minerals, ore wholesale, crude, petroleum, security brokerage, dealing, investments, advice, and related services for 12 months. In February, price fell, intermediate demand price fell 7.5%, and the producer price index periodic updates the samples of producers provided index data in order to reflect the current conditions more accurately when the structural membership technology or product mix of industrial shifts since 1986. These sample changes have occurred in semi-annual with release of data from January and July intervals there, effective with the release of the PPI data for June of 2015 and January of July on July the 15th. The PPI will upgrade samples of triannual basis with the coinciding with the release of February, June, and October. So let me just get one other little item here. I think we can find it. This was intermediate demand by production flow, and these are various stages here. So that is the producer price index that sheds a bunch of light, obviously, on what's going on. Let's go to the International Energy Agency releases the report for March, having bottomed out in the second quarter of 2014. Global demand growth has since steadily risen, with on a year-to-year gain estimated at 0.9 million barrels per day for the first quarter of last year. It'll be 2014. For March, information, global supplies rose 1.3 million barrels to an adjusted 94 million barrels in February, led by 1.4 million barrel gain in a non-OPEC output. Declines in U.S. rig counts have yet to dent North American output growth. Final December and preliminary current quarter shows a higher than expected U.S. crude oil production, thus glutting the market. OPEC crude oil output edged down 90,000 to 3.22 million barrels as losses in Libya and Iraq offset higher supplies in Saudi Arabia, Iran, and Angola in that mix. Crude oil refineries output estimates have risen to 78.8 million barrels for current quarter, 77.3 million for the Q2 on a sustained high margin, slightly more robust oil demand outlook. Annual gains are forecast at 1 million for the barrels are there at that's 2015, down from 2.2 million in the final quarter of 2014, in line with projections there. Commercial stocks rose by a weaker than average 23.1 million barrels in January to 2.773 million barrels. Their average of 60 million barrels. U.S. crude oil stocks rose a record 72 million barrels. Preliminary data shows stocks grew by a week 8.8 million in February as extended U.S. crude bill offset weak weather-related product draws. So this is from the International Energy Agency. And let me get this from Reuters here. Crude oil prices tumbled on Friday, fell 9%, hit by renewed rally of the dollar and warnings by the International Energy Agency that the oil glut is growing, no doubt about that. Data that has shown a sharp drop in the number of U.S. rigs for oil failed to inspire the market. Brent crude below $55 a barrel. And U.S. crude settled near 2.5 month low of 45. The dollar hit the 9-year high there, and the 19 commodity indexes by Thomson Reuters core commodity index fell to a 6-year low. We aim to break the year's low in crude oil next week. In oil bear at Taisi Capital. This is Tequil Zekar. In New York, crude oil fell in January to $45.19, while the U.S. crude oil dropped to $43.48. Oil began the year lower after, of course, the report of the glut. The only bullish factor today was data from service firm Baker Hughes, we'll get to them, showing the number of rigs for drilling for oil in the U.S. fell by 56 this week to 866, the lowest since March of 2011. A lower rig count signals a drop in oil output. News of the government's proposal to buy up 5 million barrels for strategic storage also elicited little interest in the markets. And we won't get to where Brent crude is here. We'll move on to Texas. And this is a very interesting article here in the state of Texas and how it affects the real economy in the Lone Star. Now, with the Lone Star State here, and in several other states that depend on petroleum. This is a Texas oil gas barometer, falling, job losses climbing. This is from NGI Shell Daily, something we've added to our account here. And this is by Joe Fisher and dated the 13th. That would have been on Friday. If the economic health of Texas oil and gas industry were an elevator, its only direction would be down for crude oil prices, rig count, drilling permits, equipment, and for the Texas Petro Index, that's TPI, which most recently has shed 7 points, according to an economist who has been keeping score. The total oil gas employment in the Lone Star State declined by 3,300 jobs in January from an estimated level of 305,000 jobs in December. January 2015 employment data was released in March as part of the Texas Workforce Commission's revised process, and the estimated appears to indicate that what we knew coming, that the number of oil gas jobs in Texas were beginning to decline at some point. Like this is now the case. This is from Kerr Ingram, a consulting petroleum economist for the Texas Alliance of Energy Producers. Several thousand jobs were lapped off the original industry employment estimates for the latter part of 2014, it seems likely that the upstream oil and gas payroll employment in Texas peaked in December at 205,000. The January monthly decline very likely represented the onset of industrial employment contraction on the way to what will ultimately be tens of thousands of jobs lost. The TPI fell 7 points to 299.6, following a rapid decline in crude oil prices. The rig count and drilling permits indicated further weakness in Texas and oil and gas. As to the economist Ingram, crude oil prices declined 51.3% from last year at 91.38 to 44.46, and are down more than 55% compared with the June 2014 peak. Every economic indicator decreased in February, including drill count, oil count, gas completions, and drilling permits. The industry added 25,000 jobs in Texas last year, pushing the upstream employment to more than 300,000 for the first time, and simultaneously creating thousands of jobs elsewhere in the state's economy. Called the Texas Miracle by their former governor Rick Perry. But for now, that run is over. 2015 will be a year of dramatic contraction in Texas oil and gas employment, he said, adding that the contraction gripping oil and gas exploration and development in Texas is still in its early age. The TPI only peaked in October. Production continues to climb. Inventories are stacking up. Expectations simply must be that the future price pressure will be downward, not upward. Until the situation of oversupply is corrected, these trends will continue for months to come. We are prepared to settle in for a fairly long downturn before the industry begins to recover, with help from Saudi Arabia, may I add. A composite index based upon a group of upstream economic indicators, the TPI in January was 299.6. That is 0.8% higher than in January of 2004, but 7.1 or 2.3% lower than the TPI in December of 306.7, which was revised in accordance with updated industry employment data. Before embarking upon the current downturn, the TPI peaked a record of 310.5 in November, the zenith of an economic expansion that began in a depression. December of 2009, when the TPI stood at 187.7, another leading TPI indicator during September. Crude oil production in Texas totaled an estimated 102.1 million barrels. That's about 20% more than in January 2014. Crude oil prices in January averaged 44.46 there. And crude oil production totaled about 4.54 billion. That's 41.4% less than in January of 2014. Estimated Texas natural gas output was nearly 687.4 BCFs, slightly year-over-year monthly decline of 110%, with natural gas prices in November averaging 2.96. The value of Texas produced gas declined 36% to $2 billion. Baker Hughes count, we just heard about that, but let's get to it. Rig count in Texas averaged 7,7 ended with 773 in January.